Welcome to the Mind and Money. My name is Douglas Lodmell, and my guest today is Neal Rubin. Neal manages over $3 billion, his firm Rockdale Management. And I've asked you here, Neal, thanks for coming. Really, it's a pleasure to have you.
Thanks for having me.
And I really wanted you here because, you know, managing $3 billion worth of assets gives you a perspective that the average person just doesn't have. Not only is it a lot of money, but it's a lot of different people. This is not your money. I mean, you're managing other people's money. It's kind of like being in front of the camera. You hold yourself a little higher when you're working for someone else.
Absolutely.
So I really appreciate you coming, and I know we've had some conversations already that are fascinating to me, and I really want to get into them. But tell me and everybody, you know, really your background and how you got into this.
Sure. I graduated from Brandeis University with a BA in economics.
Yeah.
Really didn't know what I wanted to do, so I went to business school right out of college. I went to Harvard, graduated with an MBA from Harvard University. Still really not knowing what I wanted to do, went into banking. A couple of my professors at Harvard said, if you want to try to figure out where to be in the economy, banking's a great
figure out the money.
Yeah, know where the money is.
Yeah.
And I was fortunate. I started with a regional bank back when there were a lot of regional banks. Doing a lot of different things. Credit, management information systems, commercial lending. Ultimately ended up in private banking and gravitated toward the money management side, which I began to have a love for.
Wow, I didn't realize that because that's how I started my career as well.
Really?
Yeah, I was in the management training program, Barnett Bank, which is a regional bank here in Florida.
Right.
Same thing, you rotated around to the different departments and credit analysis. And, oh, that's very interesting.
It's a great background, a great way to understand a lot of different things and get a lot of different perspectives. And I'd always liked the stock market and found that I really liked it. I liked talking about it with people. I enjoyed the professionals that were in it, and went into the money management side and started out again on the private banking side for commercial banks. Ended up doing some work offshore with a Swiss bank before I ended up at Rockdale.
Okay.
And I do want to say, in terms of Rockdale, we manage $3 billion. There are a lot of people there that do it beyond me. We have a very large research staff and professional investment people that.
Right.
Really
this is a big firm. I mean, you guys are you're serious about it.
Yep.
I'm very interested because here's the funny thing. Most U.S. people, including probably you and I when we first got into the management programs at the banks, really saw banking and the financial world as a domestic thing, as a U.S. thing. And my clients, when I say we will open a Swiss account or we'll use Switzerland, there's an instant like, whoa, wow, that's really, you know, that's different. Is it safe?
Right.
Tell me how that switched for you when you went and worked for the Swiss banks.
Yeah, you know, in some ways, it's a disadvantage because, as you know, when you become familiar with something, it becomes very normal to you, and it's a different perspective with people that don't have that exposure. You know, banking in the developed world is very similar all over the world.
Right.
And the Swiss specifically have a history of banking that probably predates the establishment of the Republic in the United States.
Right.
They are heavily regulated.
More so than us, by far.
And the banks are very safe. And frankly, the banks that we deal with at Rockdale Offshore are private banks that don't make loans. They don't do proprietary trading. All they're doing is holding money and managing money in some cases.
Right.
And they get paid very handsomely for that.
Right. And so for everybody listening, I mean, this is a really important concept, and it really goes to the fundamental strength of the system. If you have a commercial bank, they're making loans, subprime loans, whatever kind of loans.
Absolutely.
And they are risking their money, so they're leveraged. They have a leverage ratio. A Swiss bank is a trust banking system, which means basically we're not going to lend out your money, but in order for us to do that, we got to get paid. We're going to charge you directly.
Correct. And the Swiss have both kinds of banks.
Right.
In the United States, it's really sort of amalgamated. But you know, the banks themselves are very safe as a result of the fact that they don't lend out your money.
Right.
So
they don't trade your money.
Correct.
They don't have a trading desk.
Correct. When you deposit money, and people also mistake a deposit for custody, which is how our money's held.
Yeah.
When you make a deposit at a bank, your money is actually now a liability of the bank. It's on their balance sheet. And as you said correctly, they lend it out. When you set up a custody account, it's not on the books of the bank. It's a segregated account.
It's your money.
Correct. It's always your money. Creditors have no access to it.
Right.
It's a different concept. So, two things. We have very safe banks, number one. Number two, the way the money is held is segregated and is also very safe. Now, if we then take that money and open up a bank deposit, we get bank risk.
Right.
But if we buy bonds, if we buy stocks, if we buy ETFs, if we buy mutual funds, those are segregated. They're not on the books of the bank. Big, big difference.
Yeah, fundamental.
Huge.
I tell clients that when they say, is it safe? I say it's safer by a factor of 10. I mean, to me, because when you look at what happened in this country in 2008, I think it really shook everybody out of their sleepiness around the way we do our fractional reserve banking system and the risk that we're taking. And notwithstanding that we have this, I'm going to call it an illusion of security around FDIC, because frankly, if FDIC were doing their accounting and really accounting for and pressing the banks to account for, we would have some fundamental problems with their solvency. And today I am recommending and opening more Swiss accounts, not for asset protection, directly in terms of a lawsuit, but in terms of just diversifying bank risk.
Yep. Diversification is always a good idea.
Yeah.
This is a concept that's unfamiliar to people in terms of diversifying where you hold your money.
Right.
It's totally legal.
Yeah.
You have to do additional reporting for the government, but the government has no problem with it whatsoever as long as you do that reporting.
Right.
And it's just, I think as you said, it's a very smart thing to do.
Yeah. Now, we're talking about diversification. One of the things that you have access to in a Swiss banking platform that you just don't in the US banking platform is very easy to diversify the base currency of your account.
Yep.
Tell us about that. How do you see it and how do you use it?
Well, for hundreds of years, Switzerland has been the go-to jurisdiction in the world, really, for people to protect their wealth.
Right.
The currency's always been very stable. Their clientele, oftentimes who you are as a result of sort of what you do or what your work is. Well, their clientele has always been global. Europe, up until the advent of the euro, was a multi-currency zone.
Right.
So that was always very familiar to people there. So as a matter of course, when you open up an account, it is a multi-currency account.
Right.
You can name any reference currency you'd like, and you have access to any currency you'd like. So we're very customized. So we focus on what the client needs are. Not everybody wants to diversify their currencies, but for those that do, it is extremely easy to do there.
Right. Well, and I think that today, again, this is a conversation, and it's one that most Americans are just not used to having, which is why I'm having it here as much as possible, is talking about, what is the risk today of holding your money in US dollars in US banks, in US-based investments like municipal bonds or bonds, fixed income. All of these things now have a necessity to put awareness to in a way that they didn't even 5 years ago.
Yeah, I mean, clearly a lot's happened in 5 years. By the same token, the world has changed just as a matter of course. The world's become more global.
Yeah.
People in the U.S. are more aware of the outside world than they've ever been.
Yeah.
The U.S. is becoming less, I don't want to say less relevant, but less of a force. I mean,
less relevant.
Less relevant.
I mean, still very relevant, but
exactly.
less than it was. Yeah,
right.
absolutely.
But not in a negative way, and really in a natural way. I mean, after the Second World War, the U.S. was, really the unscathed superpower.
Yeah.
I mean, clearly the Soviet Union was another superpower, but they had been devastated by that war, unlike us. And over time, Japan, Germany, the rest of Europe grew significantly. I mean, it wasn't so long ago that people were saying Japan was going to overtake the U.S. Well, that didn't happen. But the U.S. became less relevant after the Second World War, and that trend is now continuing as the developing world gets larger and grows. And so from our perspective, we don't really have the perspective that the U.S. is ending, that the dollar is going to collapse, that the U.S. economy is going to collapse. But we do have the perspective that the U.S. has issues coming out of this financial crisis. A lot of other areas of the world don't. There are growth opportunities outside the U.S. that are going to be greater, and there is a world of companies outside the U.S. that clients should have access to. And if you just look at normal diversification, everybody's used to diversification in the U.S. and thinking about whether it's asset class diversification or sector diversification. People do that naturally. If you look at the world and you look at global capital markets, the U.S. is, I don't exactly know the number, maybe 43 or 40% of the global capital markets right now.
This is what this issue is fundamentally one of the greatest benefits of expanding your mind, is understanding where we sit in the world and the opportunity that exists outside of that. Right. How do you see that?
No, we would agree with you 100%. As I stated before, there are tremendous opportunities in various countries around the world. I mean, look at the growth rate for China, for example. Slow growth in China is 7-8%. That's considered to be a problem. In the U.S., we think over the next 10 years we're going to be lucky, maybe not lucky, but our growth is going to be 2 to 2.5%.
Right. Which is to point out, it's part of the cycle. We're a mature economy.
Correct.
That's okay.
Correct.
But if you want growth in your portfolio, go to a growing economy.
Correct. And if you believe in diversification, and if the U.S. is just a piece of the global capital markets,
pretty hard to say it's not now, yeah.
Right, and it's always been a piece. It's been a larger piece, but a shrinking piece. There are opportunities in Brazil. There are opportunities in Korea. There are opportunities in Norway. There are all these countries that are growing at a faster rate for purely obvious reasons. Why not get access to those? And if the U.S., I mean, if you're going to be doctrinaire about it, you could say, look, the U.S. is half the global capital market. Well, my exposure in my portfolio on the equity side should be 50% U.S. Now, most people aren't willing to do that, and we're cognizant of that, and we're fine with that, because we always want our client's risk profile to drive what we do.
Well, and you said that earlier, and I'd really like to understand what you mean by that.
Well, you know, as we were talking about, people tend to be emotional about their money.
Yeah.
And the firm, when it was founded 30 years ago, was founded on the concept that high net worth individuals and families needed to have their money managed the same way institutions do.
Right.
So you want to have an open architecture, use multiple managers, which we do within the firm. You want to diversify, which is something we're talking about here. But also, very importantly, you want to focus on risk. What's your risk-adjusted return?
Right.
How much volatility can you withstand in a portfolio? So when you look at something like U.S. versus non-U.S., you have to be cognizant of the fact that typically non-U.S. markets are more volatile than U.S. markets. They're also less familiar. And since people tend to be emotional about their money, we want to understand that. We don't want to expose them to risks that they don't necessarily understand. And when you invest in non-U.S. markets, you have this higher volatility. It's there. You have better returns, but you have more volatility.
Right.
And you also have the currency risk. And you know, as much as the world is growing, we live in a dollar world here in the U.S.
Yeah.
And currencies are very hard to predict. You know, there was a time earlier this year when people were talking about the euro going to parity with the dollar.
Yeah.
The euro was going to fall apart. The dollar strengthened significantly. If you had non-U.S. investments, you were going to be losing money.
Absolutely.
Doing nothing.
Right.
Then the euro went back to $1.50 for some unknown reason. Now it's back to $1.35.
Right.
So when we construct portfolios, we always want to be cognizant of that. And
it's more levers to pull is what you're really talking about, which is if you don't know how to manage those levers, don't do it. Stay out of it.
Correct. Or if you don't understand the implications of the lever, what happens when you pull it, what could conceivably happen?
But if you do understand it, the opportunity is much greater, because it's just like saying, wow, we're going to graduate you from this simple camera to this more complex one. Once you know what you're doing, you need those levers. You need to be able to adjust them, fine-tune them. And so this is really the difference between professional money management and amateur money management. Right.
Well, there's so much information out there, and there's so much to understand. And we get research in from some of the best independent research firms in the world. We have some very, very smart people working for us.
And you have a model that you're following as well.
We do.
Tell me about it, because I know if we could go back to 2008, it's a line in the sand that we all know now very well.
Right.
what did you guys do leading up to that and through that?
Right. Well, and it really even started before 2008. You know,
Okay.
as you said, we have a model, and it's very much focused on not just return. It's easy to talk about return. You know, everybody wants to get a 10% return and not take any risk.
Yeah.
You know, 10% is above the long-term median return for the S&P 500 right now. And if you're going to be invested in the S&P 500, you have to be willing to accept a 37% downside.
Yeah.
Right. So we've always been focused on risk and return. Our entire model's focused around making sure each individual client gets their own individual risk budget.
Right.
People are very emotional when it comes to money. Money is one of the few things I know of that people really like to buy when it's expensive.
Yep.
Market's up, everybody wants to buy
Yeah,
it.
jump in, I'm missing something.
Right now, everybody wants to buy bonds. There's been a wall of money going into bonds. Bonds are very expensive, but if you talk to most people, that's what they want to buy. On the other hand, you know, when the stock market in March of 2009 was trading at 6,700, the Dow, and the S&P was at 680 or something like it, nobody wanted to get near those things.
Yeah.
So we know people are emotional about that. So we want to understand what their downside volatility is.
Yeah.
Getting to your question about 2008, at the end of 2007, we saw two things. The independent research that we get, the data that we saw, was pointing to a recession.
Okay.
And it was pointing to a recession that was much stronger than the prior two. The prior two had been relatively weak recessions.
Yeah,
The country got
hardly
through them quickly.
noticeable.
Exactly, not painful at all.
Yeah.
We saw it being harder. By the same token, we also saw volatility in the market rising. That meant the volatility in our portfolios was going up. We don't look to time the market because we think that's impossible. But to mitigate that volatility, we needed to raise cash. We started doing that in December. We continued to do it January, February, March. By the time March, April rolled around with new clients that brought us cash, we were not investing that money in anything.
Right.
And
So
clients
your response was to just take the money off the table.
Exactly.
Yeah.
So by the time September rolled around, with our existing clients, probably about 50% of their equity portfolio was in cash. New clients, they were 100% cash. We weren't buying anything, and they were paying us a fee for that. And we told them, look, you're going to be happy.
Yeah.
Our mantra was, it's about a return of capital, not a return on capital.
Yeah.
And that worked. Now, unfortunately, our crystal ball wasn't perfect because they never are. We didn't see Lehman.
Yeah.
The right answer was 100% cash for everybody. But again, nobody can foresee the future.
You did pretty good. 50% cash, seeing it as well as you did. Congratulations. I mean, that was good.
Thanks. I mean, you know, for the people that are always saying everything's going to fall apart, they were right.
Yeah.
You know, we're not doctrinaire. We like to call it according to the data as we see it. And then in February, we started buying fixed income again, which was a great call. And we started buying equities in April and May.
Okay, so two things that I want to go over. One is, where do you see us now based on your models?
Right.
Because a lot of people say that the bubble that existed in 2008 is not gone. It's just been transferred from the real estate market into the stock market. And there's even a bubble beyond the stock market, which is the credit bubble itself.
Right.
Which is the biggest bubble at all.
Right.
What do you see?
Yeah, well, again, our work is really based on a lot of hard data. And there's been a lot of academic research as to what happens to developed economies that go through the kind of financial crisis that we did, which are based on over-leverage. I mean, the consumer was over-levered. Now the government is over-levered. But
the banks were over-levered.
And banks are always over-levered because they basically operate with 3 to 5% capital, right? So they really can't afford to make mistakes.
Well, not to mention the investment banks that are levered far beyond that. I mean, there's a $700 trillion derivatives accounting out there that's somehow going to get settled one way or another.
Right.
You know?
Although a lot of that sort of washes out.
Yeah, it's hedged, but yeah.
Right, but regardless. But in fact, there's a book out, not that I'm here to sell books or whatever, but there's a book out called This Time is Different by Carmen Reinhart and Kenneth Rogoff.
Is it really?
That goes through, yeah, it is. Well, and
I love the title because everybody always says that, and so far it hasn't been.
Right. Well, but it is sort of. But
okay.
But what
is
they
it?
do,
Yeah.
well, the difference is, frankly, is that up until now, we've had these various crises that have been solved by additional debt being layered on. And you just talked about it before.
Yeah.
The real estate debt bubble has been solved by the government taking on more debt.
Yeah.
Now, this book and basically some other research we have and our analysis on this says, the lender of last resort. I mean, who's the government going to borrow from? I mean, I don't think there's a bank on Mars
no
right
one.
now.
Right. Yeah.
Right. So that's why this time is different. This is really looking at the post-World War II history. It's been a history of economic crises being solved by additional leverage.
Okay, so that hypothesis is, I would agree with. This time it is different. We have gone to the lender of last resort.
Right.
What's the result, though?
Well, we think the result's going to be, and this is what the data has shown, when an economy goes through this period of building up excess leverage, the answer is deleveraging.
Deleveraging, yeah.
Right. Now, there are a lot of people that translate that into a debacle. We don't think it's going to be a debacle, and we don't think it's going to be any sort of tremendously positive event either.
Right.
If you look at the numbers, if you look at the numbers, basically what happens to these economies is they grow at a very slow rate for 10 years. That means they have high unemployment for 10 years.
So we're in for a lost decade of Japan, of basically slow growth, higher unemployment. We're going to de-lever. The government is going to de-lever.
Correct.
We're going to have to be forced to reform Social Security, Medicare, our tax code. I mean, is that part of what you're seeing?
Right. Well, one of our outside money managers, one of the things that he said that I really liked is basically that which cannot continue cannot continue. Right? So
when it's over, it's over.
So there's a basic reckoning there. Probably not as bad as Japan, because frankly, we did things correctly that Japan didn't. Japan
so hold it, because I want to come back to that. This is something I want to finish.
Okay.
We'll be right back. Thanks for joining me on The Mind and Money. See you in a few.